Are you struggling with financial decision making? Are indecision and second guessing holding you back from making smart financial choices? Warren Buffett's 7 rules provide a clear framework for making informed and confident investment decisions. Now, let's master Buffett's rules to gain confidence and control so that you can eliminate doubt and help yourself navigate your financial future with assurance. Number 1. Invest in what you understand. Warren Buffett has always emphasized the importance of investing in industries and companies that you truly understand. Early in his investment career, Buffett made significant gains by investing in businesses he was familiar with, such as textiles and insurance. For instance, his investment in Geico was driven by his understanding of the insurance industry and its fundamentals. This knowledge allows him to assess the company's potential accurately and make informed decisions. When you invest in what you understand, you are better equipped to evaluate risks and opportunities. Knowledge leads to confidence, enabling you to navigate market fluctuations without panic. Buffett often advises investors to stick to the circle of competence, meaning you should focus on sectors where you have expertise or a strong interest. This approach not only minimizes risk but also enhances your ability to spot undervalued opportunities. As you embark on your investment journey, take the time to research and understand the companies you are considering. By doing so, you empower yourself to make smarter investment choices that align with your financial goals. Remember, informed investors are often the most successful ones. If you are enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start your financial journey. Number 2. Focus on long-term gains. Warren Buffett is a staunch advocate for long-term investing, believing that patience is a crucial ingredient for financial success. His investment strategy often involves holding onto stocks for years, if not decades. A prime example is his investment in Coca-Cola, which he purchased in the late 1980s. By holding on to this stock for over 30 years, Buffett has reaped substantial rewards, demonstrating the power of a long-term perspective. One of the key benefits of focusing on long-term gains is the magic of compounding. When you invest your earnings, your money begins to grow exponentially over time. This compounding effect can significantly increase your wealth, especially when you allow your investments to mature without interference. In today's fast-paced market, it's easy to get caught up in short-term fluctuations and daily news cycles. However, Buffett advises against reacting impulsively to market volatility. Instead, he encouraged investors to maintain a steady course and trust in their long-term strategies. By focusing on the bigger picture and resisting the urge to chase quick profits, you can position yourself for lasting financial success. Remember, investing is a marathon, not a sprint. Number 3. Looking for quality companies. Warren Buffett has always stressed the importance of investing in strong, reputable companies with solid fundamentals. One of his most notable investments is in Coca-Cola, a brand that has not only stood the test of time but has also consistently delivered value to its shareholders. Buffett recognized Coca-Cola's strong market position, brand loyalty, and robust financial health, which made it a prime candidate for long-term investment. Quality companies tend to withstand market volatility better than their weaker counterparts. During economic downturns, these firms often have the resources and resilience to navigate challenges, maintaining profitability and stability. This is why Buffett focuses on businesses with a competitive advantage, often referred to as economic moats. These advantages can include strong brand recognition, unique products, or efficient operations that set them apart from the competition. Before making any investment, it's crucial for viewers to assess a company's fundamentals, such as its earnings history, debt levels, and management quality. By investing in quality companies, you not only reduce risk, but also increase the likelihood of achieving sustainable growth. Remember, investing in strong businesses is a key strategy for building long-term wealth. Number 4. Be fearful when others are greedy. Warren Buffett's investment philosophy often embraces the concept of contrarian investing, which involves going against the prevailing market sentiment. One of the most notable examples of this approach was during the financial crisis of 2008. While many investors were panicking and selling off their stocks, Buffett seized the opportunity to invest in companies like Goldman Sachs and Bank of America at significantly reduced prices. His willingness to buy when others were fearful allows him to capitalize on undervalued assets. Fear in the market can create unique buying opportunities for savvy investors. When panic sets in, stock prices often plummet, regardless of a company's underlying value. This is where Buffett's wisdom shines. He encourages investors to remain calm and look for quality companies that are temporarily undervalued due to market hysteria. By adopting a contrarian mindset, you can position yourself to take advantage of these moments of fear. Instead of following the herd, focus on the fundamentals and long-term potential of your investment. Remember, staying composed during market fluctuations can lead to significant rewards when the dust settles. Embrace the opportunity to buy low and watch your investments grow over time. Number 5. Diversify wisely. Warren Buffett has often shared his views on the balance between diversification and concentration in investing. While diversification can help mitigate risk, Buffett warns against over-diversification, which he believed can dilute potential returns. He famously stated that diversification is protection against ignorance, suggesting that if you truly understand your investment, you don't need to spread your money too thin across countless assets. Instead, Buffett advocates for having a focused portfolio comprised of a few high-quality investments. This approach allows you to concentrate your resources on companies you believe in and understand deeply. By investing in a select number of strong businesses, you can monitor their performance closely and make informed decisions based on the fundamentals. To choose a few quality investments, start by researching companies with solid financial health, competitive advantages, and strong management teams. Look for businesses that you can confidently hold for the long term. Remember, it's not about how many stocks you own, but rather the quality of those investments. By diversifying wisely and focusing on what you know, you can create a robust portfolio and stand the test of time and maximizes your potential for growth. Number 6. Keep learning. Warren Buffett is a firm believer in the power of continuous education, often dedicating several hours each day to reading. He famously reads newspapers, financial reports, and books, absorbing information that helps him make informed investment decisions. Buffett's lifelong learning approach has been a cornerstone of his success, allowing him to adapt to changing market conditions and refine his investment strategies over time. For viewers looking to enhance their investing skills, reading books and articles on investing is essential. There are countless resources available that cover various aspects of the market, from fundamental analysis to behavioral finance. By immersing yourself in these materials, you can gain valuable insights and develop a deeper understanding of investment principles. Number 7. Stay disciplined. Emotional discipline is a vital component of successful investing, and Warren Buffett exemplifies this principle through his disciplined approach during both market highs and lows. For instance, during the dot-com bubble in the late 1990s, while many investors were caught up in the frenzy of tech stocks, Buffett remained steadfast in his strategy, avoiding overvalued companies. Conversely, during market downturns such as the 2008 financial crisis, he continued to invest in quality businesses, demonstrating his commitment to long-term value rather than succumbing to fear. For viewers, the key takeaway is to stick to your investment strategies regardless of market sentiment. Establish clear goals and a well-defined plan, and resist the urge to make hasty decisions based on fear or greed. By staying disciplined and focused on your long-term objectives, you can weather market fluctuations and ultimately achieve greater financial success. Remember, patience and discipline are your best allies in the investing journey. If you want to know more about the secrets like this, check out the video here and see you there.